Hi, Brian Evans here. I wanted to record another update on what we're doing with the portfolios. Coming to you from my home office that I've been working at for 2 months. I think I need a haircut, but we'll just get right down to business. The first thing I want to do a little recap on where the portfolios are and have been. As you may recall, we did take a short position, the inverse of the S&P, early on with the coronavirus, and that proved to be a good call. The second part of that was when to get back in, because we had a lot of false starts as it was dropping. Every so often we have a day where the market was up 800 points or 1,000 points, and gee, is that the new bottom? No, they drop again and do it again. It did it several times, but there was one up day when it was hit about 19,000, and that was the day we picked to get back into the market, get out of the inverse and get back into the long position. And that turned out to be the right day. And then we were able to ride that back up some. So our portfolios are down single digits at the most across the board. So very happy about that given coronavirus. But they're actually down even less when you consider, and some are even up, I suppose, people that own fixed index annuities with the right measurement dates actually have seen increases in certain circumstances if they had the particular annuity and the particular dates. But those have an annual floor of zero, so we can't go backward on those. I know the last couple of years people have been a little reticent about getting into fixed index annuities because the markets were so good. They were thinking they were missing out. But now that we've had this, they're feeling pretty good across the board owning those. I am excited that Allianz has come out with a new product that allows for increasing lifetime cash flow. The difference is we've had a product from theirs that does that, which I love because not only does it do something stock market can't, security, the annual floor of zero, and increasing lifetime cash flow. Stock markets aren't good at security and cash flow. But the one that they had, you had to wait 10 years to turn it on. So I was able to use that in a lot of portfolios as kind of an old age kind of protection for cash flow in your older age to take care of longevity risk, market risk, and inflation risk. But their new annuity allows us to start it at any time. And so it looks like the sweet spot on that is you have to wait at least maybe 4 years. But if you're thinking you might want some more security in your portfolio, increasing lifetime cash flow, and not have to wait 10 years to start it, we now have an option that looks really good. And I've been using that in my new retirement plan. So if that's something you want us to look into, let us know on that. I've also been very pleased with the real estate investment trusts overall. Publicly traded REITs took a bloodbath during the drop in the market because they were too liquid, and you don't want your real estate to be too liquid. And so with these, we haven't seen that. We've seen some minor drops in some of them, and the exchange rate REIT. I did a webinar last week with the founder and with the CEO of that company. They still haven't had a missed rent payment in their history, so that one's looking really good going forward too. So let me know if you want to learn more about that. You do have to be an accredited investor to get into that. We're looking at other real estate areas. I just did a webinar today looking at about 30 different real estate segments. And there's a few that are up. Cell phone towers, crazy segment, and data centers, and then our net lease exchange rate type properties are all up. Industrial parks are doing well too. So we'll be looking at offerings in those areas to vet those and see if they are a fit. So I got really good new annuities to look at. Potentially the REITs have kind of sorted themselves out as to which ones I want to be in going forward post-coronavirus. On the stock market side, as I mentioned, we took that short. We got back in. That was good. We really pared down any losses year to date from that. But as we saw this kind of V-shaped recovery happening recently, the markets have climbed up pretty fast, faster than I expected, and maybe a little bit too far until we know a little bit more about what's going to happen with coronavirus and when we're going to actually reopen, or are we going to have coronavirus 2? All of that comes into play. So I was looking at the likelihood of a big rally versus the likelihood of maybe a drop of some sort. And I think that there's a case to be made. The likelihood of another drop might be higher. And so we're going to make some changes. Now, there's a lot of disconnect in the market right now. People are saying, gee, businesses are really struggling. People are unemployed. How can the market go up? Well, remember the market is made up of the biggest companies, and they're not struggling. If you look at the top holdings of the S&P 500, you see Amazon and Google and Facebook and Apple and Microsoft and Intel and Pfizer and all these different companies. They're fine. It's the small businesses in your neighborhood and the storefronts and a lot of different sectors like energy and others that are really struggling. And so there is a disconnect there. So I'm concerned about the broad markets. Some of the holdings in them, some of them I think are going to do quite well. As we look at our holdings, there were certain ones that I had put in there to help protect us if the market didn't do well. And they usually have the term low volatility and high dividend in their description. But in looking at how they reacted, they were anything but low volatility because we had something unique happen with the coronavirus. So as I look at the 13-week returns compared to the 4-week returns, the 13 weeks should be low. The 4 weeks should be recovering. But as I look at our holdings, the previous high quality, low volatility, blue chip type stocks, they did the worst of all of them, the areas, because they don't have any tech stocks in them. And so I'm looking at these saying, well, gosh, you dropped more over the 13-week period. During the last 4-week recovery, you didn't recover. You actually went back even more. So I think I got a little paradigm shift where in the past we really liked our blue chip stocks and high dividend stocks and weren't too worried about them. Now I am worried about this segment. So I'm going to get us out of those positions. I'm also getting us out of the small cap and mid cap positions that we hold. So there's up to 5 positions in your portfolio I will be selling. And for those reasons, I just don't see the upside to them. I think that they're going to go through a tough time. But I do think there are opportunities in the market, and there will be other opportunities coming up once we figure out when we're reopening and what that looks like. So with those 5 positions, you may own none of them. You may own 2 of them. You may own all 5. But with those 5 positions, I'm swapping them out. So on the swaps, I'm buying some sector funds. I'm going to buy biotech stocks and consumer staples. We saw consumer staples, people are loading up on those kinds of things, and I think they'll be just fine through any kind of market. They're more of a defensive strategy, and certainly biotech, there's me opportunity there. So I wanted to get into that. We already had overweights to particular sectors. Healthcare was one of them. It's doing much better than the market. Big overweight to the NASDAQ, the tech stocks that I just mentioned. And so that's been fine. Semiconductors has been an overweight also. We have some other strategies that we're overweighted on momentum-based stocks. That's been a very good strategy. And one of our holdings is a free cash flow model. So that one looks pretty good too. So I'm trying to increase the quality of what we do own, be in the places where I think the money is going to be made, and avoid the places where it's not. Now, 3 positions that I'm selling, I'm not swapping back into equities. I'm going into short-term bond funds, and I'm doing that as a cash alternative because I simply want some money out of the market. We call it dry powder. It's money that will be available once some things sort out. We see the direction of the economy, what areas we think the opportunities are in, then we can reemploy that money at that time. So there will be a percentage of yours in the short term in some short-term bond funds. Why not just put them all into one bond fund? I want to be sniper-like in the recovery when I see those opportunities. So I want them separated out because it's virtually impossible once you commingle a lot of funds to break them out into pieces. So I'm going to keep them in their own small little pieces so that as I see opportunities, I can just sell that fund and swap it into something else. And so that's what we're going to do, just another tweak to the portfolios, recognizing that we have done pretty good so far, especially given what's gone on in the world. But there's still a lot of risk out there, even in the markets, even though they are disconnected from the carnage of the high unemployment and what small businesses are going through. But we're going to make those moves for virtually all of the portfolios. A few people have opted out, but for the most part, everybody's been on board with the changes we've been making. And I just want to let you know that I'm looking at, just continuing to monitor the sectors, the areas of the economy that could do better than others, and looking into other kinds of real estate, as I mentioned, going forward, whether it's cell towers or data centers or net lease properties or industrial properties. I think those are going to fare quite well in the future. So with every change in the world, there's always opportunity created. Just want to be ahead of it. I'm glad we're able to be nimble and make some changes that other firms are unable to. I'm glad we're able to use the alternatives that we've been using too. So if you have any questions, please feel free to let us know. But I wanted to give you this update so as you see some activity in your account, you understand there's a lot of thought that's been put behind it. Hopefully it's right again, and we'll get through this together and be back to where we can meet face to face again someday soon. Thank you for watching this video.